What's going on, everyone? Michael Album here from the Remote Real Estate Investor. We're actually in the midst of a pivot, and so we're changing the name of our show to be the SFR Show. Reason being is we really want to double down on the single family rental industry as a whole, and so we wanted to pick a title and a name that's reflective of that. So join us here on the new show, the SFR Show, where we're going to be bringing you everything you need to know about SFR investing, from what the market is doing at the micro and macro level to what the factors are influencing and changing the space. So let's kick it off with this first episode. We hope you enjoy. Hey everyone, welcome to the SFR Show. We're going to be talking today with Geoff and Sanjay on Roofstock's Web3 team about cryptocurrency, tokenization, alternative investments, portfolio theory, and risk management, just to name a few. So with that, let's just jump straight into it. Geoff and Sanjay, good to see you both. How have you been?
Great. Good to see you again. And Michael, you look really different from the last time we spoke. And so much younger and much more refreshed, I think, after the holidays.
Thank you. Yeah, I came back from the holidays ready, put some 10 pounds on and took 10 years off my face. So I'm doing the best I can. So for anyone
in there too.
Yeah, that's it. So for anyone who didn't catch our prior episode together, I'd love if you could give a really quick intro, who you guys are and what is it that you're doing here at Roofstock.
So yeah, we are co-leading the Web3 business unit at Roofstock. I'm Geoff Thompson. This is Sanjay Raghavan. And we have been at Roofstock for several years. And over the last year, we've spent all of our time focusing on how to use blockchain and Web3 technology to improve the real estate transaction process and to generally make single-family rentals more accessible as an asset class.
And for anyone who isn't familiar with what Web3 is, definitely go back and give that prior episode a listen. Sanjay gets into it and kind of what the technology is. So I'm curious, gents, where we are today, where are you seeing blockchain and tokenization playing a role in the single family space?
Mm-hmm. So first of all, we had a sale of our Genesis property in mid-October. So for your audience who may have read about it on crypto Twitter or on media publications, that was a very successful launch of this product. We had spent about 10 months working on legal and tax analysis of how to structure this product so that it would be compliant. And when somebody was purchasing this property in a Web3 home, they were in fact getting ownership of the underlying asset. So that took us about 10 months to engineer. And the first sale that happened in mid-October was a huge success, went viral on crypto Twitter, and was picked up by all the leading crypto and non-crypto publications. And the reason for that was because for the first time, what had really happened in crypto and blockchain, which if your followers are looking at the market in general, this has been a really particularly bad year in the industry for the stock market. Inflation has been at a 40-year high. Feds have been drastically, we went through 475 basis point interest rate hike.
Right.
And so, we're going through this very tumultuous time in the industry, and crypto has not been an exception either. Crypto's been having an unprecedented winter where either Bitcoin and Ethereum lost 60% of their value since last year to this year. And then a bunch of crypto companies went insolvent because of various, either it was just poor risk management or just, for whatever other reasons, they didn't have the capital to withstand this bear market. So during these times, this was sort of like a ray of light in the Web3 industry because we had successfully demonstrated that it was actually possible to sell a single family rental property, which normally is a 3-4 week closing process, was done instantaneously using Web3 technologies. But we were also able to find a leverage partner who was able to provide a loan for that property at a 65% LTV. And so the combination of all of this really was a very positive thing in the industry, and we got a lot of outreach because of that.
Hopefully,
specifically with respect to
wasn't FTX, right?
No, the leverage partner wasn't FTX. They were Teller Finance. But specifically, about your question about, with respect to blockchain tokenization, what does that really mean for real estate? Is that, we've been able to now demonstrate that it is possible to have a better sale experience, right? When you typically look at the 3-week closing process on a real estate transaction, there's a bunch of contingencies on an offer. Both the buyer and seller are extremely nervous about what happens during the diligence period in those 3 weeks. Like for example, as you're aware, the inspection results come in, and then you find out something about the property that you were not aware of before. And then there's typically some kind of negotiation that goes on the offer price after the fact. There's an appraisal contingency, financing contingency, and so anything can happen during this 3-week period. The seller and buyer, even though an offer was accepted, may have a disagreement later on, based on the results of further analysis. And sometimes the offer can be rescinded, and then you're back to the drawing board trying to relist the property and sell it. So it's a particularly stressful time both for the buyer and seller. And doing it through this Web3 mechanism essentially allows us to take a lot of that diligence, which still has to happen, but we're just moving it, upfront in the process. So the buyer and seller have access to the same information about the property, and the buyer is able to perform all of their diligence upfront. The way Geoff talks about this experience is you may spend a week or two looking at Amazon Prime to figure out what you want to buy for Christmas. But once you've made that decision, you want it to be delivered, on Amazon Prime same day or next day. You don't want to wait 4 weeks for it to be then shipped from China to, get to Los Angeles, and then from there to be transported to, San Francisco. So, we really want to make this process easy for people, right? So you do all your diligence up front, but when you decide to make that purchase decision, it happens instantaneously. And on top of that, when you add debt financing in a way that's asset-based and not based on your personal credit underwriting, you're not trying to find a lender and, sending them 2 years of tax returns and bank statements. And as you're aware, Michael, what happens in this process is you send all this information, you get a pre-underwriting approval. And then as you're getting ready to close on the property, a month or two have elapsed and all your information is outdated, and you're resending all the information back to the lender. Yeah. So, you want to avoid all of this as well, because that's also incredibly stressful as you're going through a purchase process. And here, because it's a rental property, it's cash flow generating. Based on the value of the asset, you can actually underwrite a loan and say, it's a $200,000 property. I'm comfortable giving you a $100,000 loan against it. And that makes the lending paradigm a lot simpler as well. So overall, it's generally a better experience, both for the seller and the buyer, when you bring in the Web3 technology into this process.
This is mind-blowing, you guys. So I'm curious, how are you seeing really, or rather, are people doing this at scale? I mean, we did it once, we've proven that it can be done once, but what does the scalability factor look like here for both buyers and for sellers?
It is, I can jump in here. It is scalable. It's scalable in the same way that buying and selling homes today can be done, in bulk, or you can assemble your own portfolio over time. It's not, there isn't a delayed production process in creating these and preparing them to be sold on the blockchain. We do get that question a lot. Well, how much does it cost to mint a token? Is it tens of thousands of dollars? No, that's essentially free. How long does it take? It's essentially instantaneous. The work that we do to prepare this to be sold is what Sanjay alluded to: the diligence and inspection, making sure everything, photos have been taken, taxes have been paid, HOA is square, all of those things. That's what we do up front, which has to happen in any real estate transaction. We just package that up in a very short time frame of, call it 5 or 10 days, once the home has been purchased and rehabbed, and it's ready to be listed for sale. So this can be scaled, and then once the home has been put on chain, then this is where the seller really is going to feel the scalability and the ease of interaction. Because imagine that you own 5 or 10 or some number of homes. You want to rebalance your portfolio. Maybe you want to get into one market and get out of another market. Right now, you would have to do that through the traditional process that might take a few months and involve a number of different intermediaries. In our case, if you own those homes as tokenized properties, we can get them ready for sale in 5 or 10 days, and then they can be listed immediately. And once they've been listed on an NFT marketplace, the sale can happen with one click. So you don't, as the seller, you don't have to go through, a prolonged and painful back and forth with the buyer countering after they get the inspection and, trying to haggle on the price or trying to get a discount here, whatever it might be. That's all taken care of up front. So in that sense, it does make this much more scalable and much more liquid than the traditional process.
Should audience and listeners be thinking about crypto almost like a foreign currency? And so, just quick anecdotes. So I've invested in Portugal. I signed my purchase agreement to purchase the property in Portugal back in 2020, just before the pandemic. Then, where the dollar was really strong against the euro, then the dollar tanked against the euro. And so I changed money after the fact and just got totally hosed on the exchange rate. How should people be thinking about exchange rate, if you will, between cryptocurrency and whatever currency they're?
Yeah, that's a really good question, right? And when you think about a cryptocurrency like Bitcoin or Ethereum, these are the two sort of more commonly discussed cryptocurrencies. In a way, it is you can make the analogy that these are almost as though they are sovereign currencies of their own, and there is an exchange rate between the US dollar and Bitcoin or Ethereum. The only difference here being that, unlike euro or the British pound, where they have their own fiscal and monetary policies that, determine what happens to their peg against the dollar. In the case of cryptocurrencies, they are highly volatile. And we see that they're very actually strongly correlated to the stock market today. So when, for example, there was an indication that the Feds might slow down the rate at which they're increasing the interest rates. And I think the expectation I believe this week the Fed is meeting, and the expectation is that this week it'll be a 50 basis point hike instead of a 75 basis point hike. The stock markets rallied, and so did Bitcoin with that. However, even though they're kind of strongly correlated, they're also highly volatile. And so when we talk about people having cryptocurrencies that they can use to buy these properties, we actually suggest that they buy and keep their money in stable coins, which are pegged against the US dollar. And there are companies such as Circle, which have USDC, and Paxos, which has its own version of a dollar pegged stable coin. And having your money in stable coins means that you're not subject to the same volatility as Bitcoin or Ethereum might be, which can drop or go up in value by 20-30% in a single day. And that's how we would really think about it. If people want to, have an allocation, if somebody is really long on Bitcoin or Ethereum and they want to have an allocation in that asset class, that's fine, as long as they're aware that those are highly volatile, and in the short term, they could be, fluctuating quite a bit.
Yeah. And that makes sense. And so when are you seeing people make the change from the stable coin to whatever coin they're going to be using to purchase the properties?
So the stable, you can actually purchase properties with stable coins.
Okay.
And because, we have a way to, when we receive those stable coins, for example, if we are the seller of the property and, property is purchased using, let's say, Circle's USDC, once we're paid in USDC, we have a way to convert that back into US dollars. So that's, it makes, essentially, you can think of these stable coins as programmable money, meaning this whole transaction is happening on the blockchain, and it's happening through a piece of computer code. There's no, you and I are not sitting across the table signing documents and, giving a check and receiving title in return. So this is all happening because a piece of computer code is transferring money from you to me and transferring the LLC through the NFT, giving you the LLC that I own, which has this property. And since this is all being executed by computer code, this stable coin is really, we refer to it as programmable money, because a piece of computer program is able to move money from you to me. and allow this transaction to happen in that one-click process that Geoff was talking about earlier.
It feels like this is the way things should work, right? If you think about the system that we have right now for closing property transactions, it's basically inherited from England 800 years ago. We've made small advancements, but not really. And it shouldn't, everyone who's involved in these transactions and every step that's taken is taken for a reason. It's solving a particular problem. But if you stop and rethink how this is done, you realize that by reordering some things and maybe, using a splash of new technology here, you can actually dramatically change the experience for everyone. And it's not necessarily, a zero-sum game. I think it's better for everyone. Everyone who's in the industry is going to be better off. There will be more transactions because it's easier to transact. There'll be more demand because people are interested in getting in if they know they can get out easily, right? Right now, that if you're looking at buying a property, you're probably going to have to hold it at least 5 years to recover your closing costs and wait for it to appreciate a little bit. And it's going to be a headache when you do have to sell. If you don't have those constraints, transaction fees are less and the time involved is less, you'll be more inclined to get in the market because you can get out when you need to.
And I'll also add one more thing to that, right? So, Michael, if you think about, back in the day when there were these kind of Alt-A buyers, a lot of them were like businessmen that, 1 year they might have made $500,000, but, then another year it was only 150 or something. And so it's very hard to underwrite those types of folks through a traditional underwriting process because you're looking at 2 years of income and tax returns and all of that, and a lot of them may not qualify for more conventional financing. However, in an asset-based lending type solution, as long as you have the money and you're not constrained by your income for the last 2 years or 3 years, as long as you have the money to buy the to put in as down payment on the product and the asset itself has the value, you're able to borrow against it much more easily. So, we just talked about the complexity of closing a real estate transaction in general, but once you add in the financing layer on top of that, it gets even harder because, there's again when the market's going up, you just don't know if the max. You want to make the best offer you can, but at that offer, you don't know if you will qualify for the loan because the rate might have moved since the time you initially got underwritten, and suddenly with the new rate, you don't qualify anymore for that. And you have to find that little bit more down payment to offset it or buy some points. You and I have gone through this numerous times in our lives. But, you can avoid all of those types of issues because in an asset-based lending program, that when you buy this asset, which is worth $200,000, there's a lender, if they're willing to come in at 65% LTV, that based on the value of the asset, you're going to get that loan.
And if we just decouple the crypto piece of this and blockchain piece of this, asset-based lending, is that available for regular folks?
So in the traditional finance world, it is available, right? But it becomes harder because when you're buying an investment property, as you know, Fannie Mae puts limitations on how many investment properties you can get financing for as an individual. Once you get past that limit, then you're looking at pretty much private money, hard money type lending solutions until you can get up to a scale where you have enough properties where a Citibank or a Wells Fargo or Goldman Sachs might be interested in working with you. But there's this pocket where after your first 10 properties till you get to a few hundred, you're primarily working with non-bank lenders who are generally where the rate could be 10 or 12%. And then oftentimes some of these lenders will also ask for a personal guarantee on top of it. So it's not, while it is possible to get financing on investment properties in the traditional finance world, at some point it doesn't scale very well. And, you're sort of in that desert until you can somehow figure out a way to get to 200 properties when suddenly the larger lenders are willing to talk to you. So that problem goes away when you're using blockchain and specifically decentralized finance or DeFi as we refer to it, because there incrementally each property that you're buying is getting financed based on asset value. And so, you're able to get a much more sort of a pleasurable experience to get through the lending process on the blockchain than on the traditional world.
Let's pivot just a little bit and talk about risk management and portfolio theory. And as folks are starting to scale their portfolio, or really as institutions have already a sizable portfolio, where does tokenization fit into their playbook? When's the appropriate time? When should people be thinking about it?
In general, the way I like to answer this question is, if you, as an individual, if you went to your financial advisor and said, okay, I have, $1 million I want to invest, and I want to make sure there's, come up with a portfolio allocation that makes sense for me. Typically, they're going to, like in the old days, it was just a sort of a 60-40 rule. It was 60% in stocks, 40% in bonds.
Yeah.
But I think people have gotten smarter over the last 10 years. And nowadays, when you go to a financial advisor, they're going to say some allocation in stocks, some allocation in fixed income bond products, and then an allocation to alternative investments, because that's where, you can get non-correlated yields, because the stock market moving in one direction should not, and like, God forbid, if you have an emergency and you need some cash, like this would be if you bought at the height of the market last year, this would be a really bad time to sell, your S&P 500 shares to pay for whatever you had to, right? Whether it's a wedding, a doctor's thing, education, whatever it is. So generally speaking, financial advisors these days suggest that you should have an allocation in alternative investments that are non-correlated to the stock and bond markets, and you can access that pool of capital, when you need to, right? So from that perspective, diversification, and when you talk about alternatives, there's obviously there's a wide range of assets there, but real estate is on top of mind for almost all the, anytime you talk about alternatives, real estate sort of is one of the top things people talk about. So from that perspective, almost every investor should probably be looking at some allocation, and it'll depend on their individual circumstances, whether their age, their income, their marital status, and their need for cash, their risk tolerance, and all that. But advisors might ask you to put 5 to 10% or more into alternative asset classes, and so the same financial hygiene should also be applied by corporations and institutions, because you're sort of being asked to manage the treasury of your company. Let's say you are a venture funded company and you just raised $100 million. Well, you are going to keep a good portion of that money in cash and cash-like instruments, money market, and so on, because you have working capital, you have other things that you need to be spending on. But some allocation of that you might put in U.S. treasuries, for example, right? And in the crypto world, crypto institutions may keep some allocation in Bitcoin and Ethereum and other protocols that they have high conviction in. But nevertheless, whether it's a Web2 institution or a crypto institution, it's just basic financial hygiene to have an allocation in alternative asset classes. And specifically with our product, being a Web3 product, that money can stay, essentially the token they're purchasing is an NFT, and it is part of the blockchain ecosystem. So they can keep their assets within the crypto world without having to continuously off-ramp into US dollars and then on-ramp it back into crypto when they need to switch back and forth. With respect to how they receive rental income, of course, if your properties are managed by a property manager, which they should be, because institutions are not in the business of managing properties, you can collect your rent in cash if you have, if you have expenses that need to be paid out in US dollars. But also, if you want to collect your rent in USDC or Ethereum, you have the option to do that as well. So whether you're a Web2 institution or a Web3 institution, depending on your cash needs and your crypto needs, now you can have a yield generating crypto asset, and the yield can be collected in fiat or in cryptocurrency. So, it is good financial health to do it. We encourage everybody to have some allocation, whether it's through Roofstock or through any other channels that they would like to pursue. But they should have some allocation in alternatives. It just makes sense. And Geoff, if you'd like to add something to that.
No, that's it. I mean, in our case, because we've designed a solution that allows you to transact with crypto natively, this is something that we've heard from a number of crypto or Web3 institutions that it's potentially very interesting for them, as opposed to maintaining all of their assets in a cryptocurrency or a stable coin. This is a way to get access to a diversified asset that does create yield and it does have a price appreciation component. So there are a lot of, we've heard from the Web3 community in particular that this is a perfect diversification play.
And if I'm someone that owns a sizable portfolio, maybe I own it all in cash because that's been my mantra, and I do need that quick capital injection. I mean, could I tokenize these properties and then go get asset-based lending and convert that into cash all fairly quickly?
Yes, that's you're thinking ahead. I like that. Yes, the properties can be tokenized basically any point in their life cycle. If you own them now, you bought them through a traditional sale and settlement. You can, basically what it means is you have to drop it into an LLC. And the LLC has a particular structure that we've worked out. It is very particular. So, we'll work with you to create that LLC to help transfer the property into the LLC. In most states, I think the vast majority of states, that transfer from an owner to an LLC that's owned by the owner doesn't create transfer tax obligations. So there's a little bit of the traditional closing cost, recordation fee, or whatever that might be part of that. But it is perfectly possible to onboard existing assets that you own into the system. And similarly, if we're talking about other points in the life cycle, for builders, we've had a few builders reach out and say they're close to completing a community and they might want to try to sell some of these as in an NFT form. Those new assets, those new properties that really have never been titled before, those can also be titled directly into an LLC. So it's a very flexible structure. It accommodates property at whatever stage of the life cycle it's in.
Anyone who's got conventional financing experience under their belt might be listening to this and saying, well, you're talking about lending, you're talking about LLCs. Those two things often don't jive, play nice together in the sandbox. So the asset-based lender that we're working with or that we are going to be working with, I would imagine, has no issue lending to an LLC. Is that right?
Yes, that's exactly right. The lenders that we're working with are the Web3 lenders. We have talked to numerous traditional lenders, and some of them express a lot of interest in digital assets, and maybe they've even created a team. But in most cases, the underwriting aspect of it isn't there yet. They're not ready to take this to credit committee and make a loan on the structure that we're proposing here. But that's okay because there's a lot of money that's available in the Web3 space, and it is more flexible in terms of what it requires. They don't necessarily need to have all of the same checks and balances that a traditional lender would be in terms of underwriting against the individual. They can be comfortable underwriting against the asset because they're comfortable that in the event of default, that asset it is already in their vault. So it's in the lender's wallet at the time of default. And because we're building this system where you can sell them through an NFT marketplace, there is liquidity that there wouldn't otherwise be if you were holding this, the traditional way. So to your question, are TradFi lenders, the traditional finance space, interested? Yes, we've heard some say they're interested. We haven't seen anyone actually show up to engage in detail, but there is an entirely separate pool of capital in the Web3 space that's much more flexible and willing to work with the blockchain structure.
I think my last question, guys, before I let you out of here is I'm sold. This sounds obviously like a really great product, like a really cool technology that exists. Who isn't this for? Who listening to this should think about, it's not a good fit for me because X, Y, and Z?
Yeah, I mean, I can start with a couple of things and then Geoff, you can add to that as well. So if the property already has financing in the TradFi world, this structure is hard because we can't really transfer an encumbered property into an LLC and then tokenize it, right? Because there's traditional mortgage on the property, and there's a whole kind of thing that's set up off chain in terms of financing. So it's not going to work if primarily you're looking to get off chain financing. Then this is not for you. You have to sort of follow the traditional sense. But anybody that's open to purchasing this as a Web3 property and open to looking at Web3 financing alternatives, for those people, this absolutely should be something they should consider. The one kind of drawback or question we've heard from a lot of people is they need to become familiar with how to use crypto wallets and how to essentially convert money into USDC or some stable coin and then use that to go and make a purchase. We're here to help with those types of Q&A, right? Until you do it for the first time, it's hard, but after you've done it, then it's easy, right? Just like when iPhones first came and people didn't know, which way do you swipe to do what, but then over time you get used to it. And so we're absolutely happy to help anybody that's staying in the sidelines purely because they don't understand the technology aspects of it. We can help them out. But for people that have financing constraints or other things, and for them it is until they can overcome those issues and look at sort of a pure web unencumbered property in the Web3 world with then financing added to it on the blockchain. So for those audiences, it might, until they've figured out that, it might be a challenge.
Okay. I'd also add for owner occupants, the financing isn't fully worked out yet. So the financing that we added to the initial home sale a few weeks ago, that was very much geared towards an investment property. And for the immediate future, to the extent that we're building out the different options for DeFi lending, it looks like most of them will be focused on these as investment properties as opposed to owner-occupant properties. And that's for lending law reasons, not wanting to cross over into a mortgage lending licensing requirement, and also just dealing with, the people are different, and at that point, the underwriting is different as well, because it's not as easy to necessarily sell that asset if the owner is living in it, and so that type of thing. So at the moment, we're thinking of this mostly for investment property use cases.
Really, really cool stuff. For people that have questions, that want to reach out, that want to learn more, what's the best way for them to do so?
Reach out on email or Twitter. We can drop our emails here, but it's gthompson@Roofstock, or is it S Raghavan?
Yeah, it's S Raghavan. So SRAGHAVAN at roofstock.com. I'm also ETH_Sanjay, SANJY on Twitter. So you can also reach out to me there. One thing before we sign off for today, we're super excited to say that we are in the process of closing our second property. That's going to get tokenized soon. This one's going to be in Georgia. It's an Atlanta suburb. And we'll be going through the process as soon as this is closed in the next few days. We'll be going through the process of documenting what the property looks like when we bought it and any rehab we end up doing on it. And we'll be talking about it on social media quite a bit, as well as people who are new to real estate investing. Maybe this is an opportunity for them to understand, well, what are the kinds of things people should be looking at when they're analyzing a rental property. And so as we go through the process of rehabbing this, we'll sort of document that a little bit. But that, once the rehab is completed, that'll get tokenized soon. But once the rehab is completed, we'll have it available for sale.
Awesome. We'll definitely have to keep my eyes peeled for the process and for the property once it's finished. That's super exciting. Well, guys, as always, a pleasure. Great seeing you both. Thanks for hanging out with me.
Likewise.
Thanks for having us.
Always great to chat.
Take care. Talk soon.
Bye.
Hey, everyone. That was a wrap to our show. Thank you so much to Geoff and Sanjay. Super, super, super interesting stuff. Definitely leave us a rating or a review wherever it is you get your podcasts, and definitely reach out to those guys if you have any questions about Web3, about tokenization, about cryptocurrency, home purchases. Again, really cool stuff. We look forward to seeing you on the next one. Thanks so much for listening. Happy investing.